Alright friends, once you have completed writing these points, let us move ahead and now enter into the fourth step, that is allocating the transaction price to performance obligations. So let me remind you one thing very importantly, that whenever we are talking about performance obligation, the word performance obligation is always used in plural sense. It is performance obligations. So when you identify what are the performance obligations under step 2, and if you find that there were multiple performance obligations, then when you identify the transaction price in the third step, what you need to do is allocate that transaction price over multiple performance obligations. So here there may be two different possibilities that may emerge. Number one, there is a singular performance obligation. In that case, whatever transaction price you have identified in the third step, that whole transaction price stands allocated to the singular performance obligation. However, suppose there were multiple performance obligations. Say there were 4 different performance obligations. For simplicity, I would name that as A, B, C and D. That means the entity needs to supply multiple goods or services which constitute different performance obligations A, B, C and D. Now, whatever transaction price you have identified in the third step is pertaining to all these 4 performance obligations. That means upon completion of each of these, part of the revenue can be recognized with respect to that particular performance obligations, and the order or sequence or the manner in which the performance obligations will be completed can differ. Something can happen first, something can happen later. So you don't have to wait for all performance obligations to get completed so that you recognize the whole transaction price as your revenue. No, you don't have to do that. If you are transferring multiple goods or services where there are multiple performance obligations, say we have agreed to transfer 4 different goods or services, and where we have identified performance obligation with respect to each good or service that has to be transferred, and we have named those performance obligation as A, B, C and D. Suppose B gets completed first, then the revenue that is pertaining to B can be recognized. Then C gets completed, then revenue pertaining to C will be recognized. Suppose the first performance obligation is not at a singular point of time, it is going to happen over a period of time, then such revenue will be recognized over a period of time as and when the performance is complete. How to do that revenue recognition part, that we have to deal in the 5th step. So why I am talking about this whole thing at this point, that if you are identifying that there are multiple performance obligations and the revenue recognition points for each of these will be different points of time, then you must identify one more thing: how much of the transaction price stands allocated to each performance obligation, and that is what we need to apply over here. So the general principle that applies in this context is standalone selling price. I repeat, standalone selling price. In short, you can call it as SSP. So if I am supplying 4 different products A, B, C and D, how much would be the transaction price for standalone A? How much would be the transaction price for standalone B? How much would be the transaction price for standalone C, and likewise for D? You identify that standalone price, and the separate standalone price for each becomes the basis. For example, the prices of A, B, C, D on standalone basis could be $100, $200, $300 and $400. Then the entire transaction price for supplying a bundle of these 4 goods together is suppose $900. Then you need to divide that $900 in the ratio of 1:2:3:4. How did we find this ratio? That ratio was basically a reflection of the ratio of the standalone price of each of these goods or services that we are providing. That is the basis for allocating the transaction price over multiple performance obligations, and that is where step 4 lands its focus. So let us write up some notes with respect to step 4. You may please write the allocation objective. While allocating the transaction price, the objective of the entity should be to allocate the transaction price to each performance obligation identified in the contract on a relative standalone selling price basis as per the standard. The standalone selling price is the price at which an entity would sell a promised good or service, the best evidence of which is the observable price of such good or service when the entity sells that good or service separately in similar circumstances and to similar customers. Please write up these points and then I take you ahead. Alright friends, I am sure you have completed writing this whole thing. Let us move ahead and now deal with the next and last step over here. That will be step 5, satisfying performance obligation. Now this is the last step. Here you are going to recognize the revenue, and when you have to recognize the revenue, you will always look into whether the performance obligation is satisfied or not. Now what is the key aspect over here? What is the key aspect over here? See, I'll begin with a scenario so that you understand the key aspect very well. Suppose I am a construction contractor and you are a customer. I am, say, constructing a property for you. What will happen? It is your land, correct, on which I am constructing the property. But whether the right of that property is of yours or not. So you and me, we have negotiated a contract price, say $80,000. Within that price, I'll construct this property for you. But the idea is, on that property, when do you get the right? So when I'm constructing, whose property it is being constructed? I am just a construction contractor. It's basically your property. But the point is, right now when the construction work is going on, I will let you even enter the place only and only to show you the development, to discuss things with you. Whenever you want, of course you can come. You don't have to, bring any authority for that. You are the authority as a customer. But I have not given you complete access to that because construction work is still going on. Right now, the whole activity and that asset right now is in my control. Now, when is the point when I transfer the control? One fine day, the property which is logged, the keys to that property will be handed over to you because you are the customer. You have paid me the price and I am going to transfer the keys to you. Now you have the control over that property. Legal control, possession-wise control, you have complete control. So when you have control, I have passed on that control to you. When I have passed on that control to you, that becomes the trigger point of completion of my performance obligation. But let's be aware of one thing. It's a construction contract and the contract may take, say, 3 years time, because $80,000, if that is the price I'm charging, it's not a small construction that I'm making for you. It's a big construction. It's going to take a long period of time, say 3 years. Over a period of 3 years, gradually the construction will happen. So, we generally follow something called stage of completion or percentage of completion. So, where you would admit based on the facts and circumstances that okay, by now 30% work is completed, by now 60% work is completed, by now 90% work is completed, and so on. So what is happening? Control is not getting transferred to you at a singular point of time. Of course, when the property is completely constructed, the complete possession, legal ownership, everything belongs to you. But the whole progression happened over a period of time. So if you look from my viewpoint, is it that I should wait for all 3 years and then recognize my entire revenue? look at one aspect over here. I have been working on that construction activity for a period of 3 years. So cost was incurred uniformly, say over a period of 3 years. So shouldn't I try to match the revenues with the cost? Obviously I should. That means here the standard says it is implied that the control is not getting transferred at a singular point of time. The control is getting transferred over a period. So now this could be little confusing for anyone, that how we would identify when is the control getting transferred. So IFRS 15 has laid down certain criterias to identify whether the control is getting transferred at a singular point of time or it is happening over a period of time. But the thumb rule is established. If the control is transferred at a singular point of time, revenue recognition will happen at that point of time. But if the control is getting transferred gradually over a period of time, the revenue recognition also should be over a period of time, and that over a period of time will be based on the stage of completion. Now, how one can assess the stage of completion? One could be the customer's certification of work completed. So customer has, say, appointed an engineer, a civil engineer, who will be certifying that okay, work is 20% completed, work is 35% completed, and so on. Based on such certification, the entity, that is a supplier or the contractor, can recognize the revenue. Alternatively, I can also apply one fundamental point, that how can an outside entity judge how much work I have done. For example, when I am taking your class, it is only me who can assess how much portion is completed, how much syllabus or how much remaining discussion is left over, how long I'll take, how much effort I have to put in. It is only me who can identify that, not any outside party. So an outside party may try to certify the stage of work completed, but it cannot be as accurate as per my estimates. Therefore, sometimes this stage of completion need not be dependent on outside agencies or outside parties. It could be the assessment made by the contractor itself, and therefore based on the stage of completion, the revenue will be recognized over a period of time. So let me bring forward some important notes over here so that you can write under the heading, that is step 5, satisfying performance obligation. An entity shall recognize revenue when or as the entity satisfies a performance obligation by transferring a promised good or service, that is an asset, to a customer. An asset is transferred when or as the customer obtains control of that asset. So this is the key aspect I was talking about. As and when the control is in the hands of the customer, means the good or service has been transferred. You know what? The basic condition for the word sale is what? It is the point of time where the entity has transferred all risk and rewards pertaining to the ownership of that asset. So whatever goods or service I am supplying to you, all the risk and rewards pertaining to the ownership of that good has been transferred. When that transfer happens, means basically when the control is transferred, it is now I can say that this is your goods, this is your property, this is your asset, because I have transferred the control to you, I have handed over to you. In that case, something going wrong with that goods now, it will not be my loss, it will be your loss. So some point of time we have to identify that who is responsible for the loss of those goods. For example, the goods are with me, I have not yet supplied to you, and something wrong happens at my premises accidentally and the goods are damaged. In that case, who is going to bear that loss? Obviously the supplier or the contractor will have to bear the loss. Customer will not bear the loss because the control of the goods was not transferred. It's all about transferring the control, and most important thing, transferring the risk and reward attached to those goods. Once it is transferred, means the sale transaction completes, and that is the point where we can say the performance obligation is complete. Now, In other words, transfer of control is the key determinant under IFRS 15. Such decision making on how control will be transferred to the customer is done at the inception of the transaction. So of course, before even the contract starts, how the control will be transferred is discussed and decided between the contractor and the customer at the inception itself. So I'll give you an opportunity to note down these points before I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and now write further. Indicators that customer has obtained control include physical possession by the customer, acceptance of the good or service by the customer taking on risk and benefits of ownership, the customer holding legal title, and the seller having a right of payment. See, all these points mentioned in this paragraph are indicators that the rights and risk and rewards and the control has been transferred to the customer. So when do you think I can obtain the right to claim the payment if I am the supplier? Once I have transferred the control of goods or services to the customer, obviously I will now have the right to receive my payment. So I have the right to receive payment can be one indicator. Customer is having the risk and reward with respect to the goods and services, that could be another indicator. Any of these points can be considered as an indicator of the control being transferred to the customer. For long-term contracts, now here be careful, for long-term contracts, the example I gave you some time back, a construction contract that took 3 years time. For a long-term contract, revenue is recognized based on a firm's progress towards completing a performance obligation over a period of time. It is over a period of time, not at a single point of time. Progress towards completion can be measured for in different ways. You can measure it from the input side, for example using the percentage of completion based on the cost, or progress can be also measured from the output side using engineer's milestone of the percentage of total output delivered up to the date. So basically we have already discussed these points, that I can take my internal sources of making estimates of how much work is completed, or I can rely upon the external sources, that is certification by a third party, maybe an engineer appointed by the customer. So what basis I take, the standard has left it to me. That is because I have to recognize the revenue. Standard says the entity that is going to recognize the revenue is the best judge of how much work is done, and let them identify the base on the ground of which the entity will identify how much work is completed, and accordingly the revenue shall be recognized. So I'll just give you an opportunity to note down these points, and once you finish writing this, we move ahead. Alright friends, once you have completed writing these points, let us move ahead and write further. Therefore, the key questions that need to be answered at contract inception to determine if the seller has satisfied its performance obligations are: establish what does transfer of control mean in the context of the arrangement between parties. Does the customer acquire control over a period of time or at a point of time? So look at one point over here. There are two key determinants over here. One is establishing what does transfer of control mean. How would you define what will constitute to transfer of control? That is one thing. And whether the control is going to get transferred at a single point of time or over a period of time, both of these aspects have to be decided, have to be talked about between the customer and the contractor, or I would say between the customer and the supplier at the inception itself, and that becomes the basis of revenue recognition, or I would say becomes the basis of satisfying the performance obligation. So definitely you need to write up these points as well, and then we move ahead. Alright friends, once you have completed writing these points, let us move ahead and now transfer of control over a period of time. Let us talk about this possibility. A performance obligation is over a period of time if any of the following criteria is met. Now keep in mind one thing, the language again, if any of the following criteria is met. we are going to talk about three different criteria over here, A, B and C. But for sake of mentioning, I am saying we are going to talk about three criteria, A, B and C. But the language of the standard says, if any of the following criteria is met, means what? Any of the following means any one criteria also getting satisfied, we will consider the transfer of control is over a period of time. That means if none of the criteria is met, it is implied that the transfer of control is not happening over a period of time, but it is happening at a singular point of time. Let us look into what are these criteria. Criteria A, the customer simultaneously receives and consumes the benefit provided by entity's performance as the entity performs. So as and when the entity performs, the customer is enjoying that portion of the benefit. Then it is becoming one of the criteria on satisfaction of which we can say it is completion of performance obligation or satisfaction of performance obligation over a period of time. Second criteria is the entity's performance creates or enhances an asset, for example work in progress, that customer controls as the asset is created or enhanced. So as and when the asset is being created, it is a kind of work in progress, but that asset primarily in legal title it belongs to the customer. So it is customer's asset that is being built up. So the question is, if you are the customer and I am the construction contractor, and suppose certain percentage of work is completed, you are going to identify this in your balance sheet, right? You are going to identify this in your balance sheet is your work in progress, not in my balance sheet. So because this is becoming an asset gradually being created and placed in your balance sheet with the progression of work, its value getting enhanced, the value also gets enhanced in your balance sheet as an asset. That itself implies that it is criteria B that is getting fulfilled, that indicates that the performance obligation is satisfied over a period of time. Third and last criteria, the entity's performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for performance completed to date. So basically, if I am constructing an asset for you, I should not have an alternate use of that asset. It should not happen that, okay, work is in progress, I am constructing, I find some other customer who is ready to pay higher price for that, and I transfer that property to that other customer. If that is going to happen, that means it is not a criteria where we are fulfilling this point. In other words, in that case, you cannot constitute this to be a situation that the performance obligation is happening over a period of time. In that case, it is no way indicating that the control is gradually getting transferred. For an entity to have a gradual control over the asset over a period of time, entity, that is the contractor, should not have any alternate use of that construction asset. And the other condition over there, entity has an enforceable right to payment. So to the extent I have completed the work, I have the enforceable right to receive the payment. That is why, based on that right to receive payment, I can conclude that I have completed that much work, and therefore I can recognize the revenue over a period of time based on the stage of completion. So basically, what we can conclude is, on satisfaction of any one of these three criteria, we can conclude that the performance obligation is satisfied over a period of time and the revenue will be recognized over a period of time. And in case none of the criteria is met, then we can conclude that the performance obligation is not satisfied over a period of time, but it is satisfied at one point of time. So let us do one thing. Let me give you an opportunity to write this whole thing, and that will be putting an end to this particular discussion.